3, 2, 1. Welcome to the Forex Trading Show. Forex trading live every weekday morning. Real trades, real profits, zero analysis. Set back, relax, and get ready to profit. And now, your host, Terry from FXWithTerry.com.
Good morning, fellow Forex traders. Looking at the free trade on the screen, a few different things to talk about. I've had a slight amount of volume in the market this morning. I'm going to dive into some different ideas here before we get into the trading. Again, this AUD-CAD free signal trade, the take profit is 0.89376. So you can enter that trade, enter a buy, and let's confirm what the chart looks like here. So that's the 4-hour. Just looking for the take profit. There it is. You have to actually zoom out to the entire day chart. So the buy trade is was entered down here in all of this price action area, and the TP is set here right now. So it's a terrific trade, a little bit of a slow market. So let's segue into that concept for a second here. This is, I'm going to give you a 30,000 foot view of what's going on, what you should be thinking, what you should not be thinking, because literally this video game that we play called Forex, it's exactly that. It's a game. It's 3D chess, right? It has its complexities, but it is also requires a certain emotional stability. Okay. I'm going to try to, I wish I could put this together in a linear path for you, but I can't. I'm just going to have to throw a bunch of stuff at you, and hopefully it sticks. So we are, first off, not even first off, just one of the pieces of what I'm going to put together here. We're in a very stable market compared to what we went through this past summer. Again, go look at AUD-JPY 2024 on July 11th. So we've had to overcome and adapt, and we have to overcome and adapt based off of what the market's doing. But here's what's happening with everyone. So our overcoming and adapting this past year was the concept of the auto hedge. And it has confused the daylights out of everyone. Do I tweak it? Do I change it every couple days? Hell yes, I do. We're playing with something here that that obviously works, but what is the best way for it to work? So yesterday we had a trade run not very deep on us. Okay. I think about 9 trades in the direction against us. Okay, so we entered, let's say, a buy and went about, we had to scale in about 9 trades. Now at the same time, I have auto hedge. And so what's that really say? What that says is we didn't like what happened to us last year. So we're going to change our method and our, maybe even our risk appetite to be able to take more risk in a market that was going apeshit on us last year. Now, watch what happens. Maybe we'll go into this year and we will get no apeshit moments. However, the auto hedge is really just a simple little add-on that can protect your account when a trade goes 20 plus deep or farther than we want it to go. I'm not giving you, as soon as I say that, well, it's not 20 deep, Terry. Yeah, it's, so why, okay. When it goes deep against us, because that's what the market does. It's very volatile. It's very random. So yesterday, we will have shown what you would call a negative net profit. That is a scenario you're going to have to get used to if you want to be able to trade the kind of market that we had last year. Again, go back to July 11th, 2024 and look at what AUD-JPY did. It fell through the floor and wrecked many accounts. Had you had auto hedge applied, you would not have wrecked your account, or the chances of you wrecking your account, because again, each person is different. Everybody's bidding different stuff. Some people are just taking a feed. Some people are taking 2 feeds, so they're double trading. Some people are taking 3 feeds, so they're triple trading. Some people are adding manual trades, taking the free signal on top of that. People are batshit crazy. They're scatterbrained. Right? It's just how it works. It's just how it works. When I say how it works, it's just how human psychology works. It's not very good. It's very unstable, primarily unstable. So we took a little bit of a loss yesterday on, I think it was NZD-JPY. And everybody was like, what happened? What happened? What happened is that we're trading. And the market can and will toy with you. If you go look at AUD-JPY, or really, I don't care. It wasn't AUD-JPY. Hold on a second. Let's just go pull up a chart. Even if you look at this particular pair on the day chart, now this is not easy to see, but I want you to understand that your brain sees red candle, green candle, right? But where the power lies is in these huge wicks up here. That, and we got wicks on both ends. We got a wick up there. We got a wick down here. We got another wick down here. Big wick here. Big wick here. What that means is it takes a lot of volume. Billions of dollars to move that, to push that wick up, and then for it to be where it's at. A lot of volume come into the market, and that's a day candle. So it seems to me, and I haven't really noticed this excessive of wicks. I mean, I guess we could go back in time, and maybe it's just something, that I'm becoming more aware of now. But that price action is designed for wherever your entries are, is to do what's called a liquidity grab. They are the big banks, the institutions are grabbing liquidity, pushing the price way up, but this is really where it's at. Pushing the price way up, but it's coming down. Pushing the price way up, but it's coming down. Pushing the price way up, but it's still coming down. Right? That's designed to take out your stop on the way down, take out your stop, take out your stop, take out your stop on the way down. And in fact, that's what it does, and that's what it was doing to our hedge trade. Price is moving down, but it wicks way up to take everyone out. And that's what was happening to our hedge trade. So I have been running parameters on our hedge trade in the sense that I would set a stop loss, and then I opened it up bigger and bigger and bigger, because that stop loss was getting hit with a wick like this. Okay. Let's say it was a sell trade, and it was a hedge. Okay. These wicks would push up and either take out the stop at a negative, or more importantly, what it would do is it would actually push down, like this candle did right here, push down and then wick back up. So it pushes down and sets the hedge in a break-even scenario, and then the next wick pushes up and takes out the hedge at break-even. So the hedge is dying. So when the hedge dies up here, but the price is still doing this, you're like, well, I've got a bunch of closed hedges that will break even at $1 or something, let's say, per profit. Yet my account margin level is still getting hurt because we're on the way down here and the algorithm was in a bunch of buy trades. So you see the reality of it. Like, we have to be able to play the game. There's no such thing as me creating a system for you that is 1,000,000% automated. You'd only have to look at it every 5 years. The more risk you take, the more you have to manage. And every time I say people that, they're like, oh my God, what do you mean? What do you mean I have to manage? Well, you're trading Forex. You should manage your money. I mean, talk about lazy. How hard is it to manage? The basic sense would be this. Basic trade management would be this. If the system is going into a hedge and then you're losing the hedge because of price action, you probably should re-enter it. Okay? That's management. Like, you saw the hedge being placed. The hedge got taken out because of price action. You probably should get back into it. That doesn't mean that that's not the worst time for you to get in a hedge and it's going to completely go against you. But then you can get out of it. So what I've done here, and listen, it's all in beta. It's all an experiment, right? The concept works. But what I've done was I decided that if you look at this price action, what we needed to profit yesterday from, I believe, NZDJPY, what we needed, I'm going to see if I can pull up the chart here. Let me open up NZDJPY. Let's see where it's at here. Now, I don't think this is, we probably don't need, yeah, this is going to make it difficult on me today. Let's see, FX crosses, NZDJPY. I don't think we need, this wasn't a unique experience in the sense that NZDJPY was doing anything specific. But you can see here the price action. Wicks down here, big wicks up here, more weight. Like, basically what is happening when you get a wick like this? What is happening is you're getting this massive price action in this direction, up, and in this direction, down. They are taking people out and grabbing liquidity all over the place. That's just what they're doing. And we're even looking at the day time frame. It's probably even more pronounced if you come down to like the 30-minute. But nonetheless, my point is this. We don't know what the market's going to do. So what I've done was I've turned off the stop loss and the break even on the auto hedge. And here's why. It's not that it's not being managed. We don't set a stop loss on our current trades. So everybody started freaking out when they see me testing the stop loss on a hedge. And now, hey, wait, why is that gone? Because here's my thinking. When the hedge is placed in our auto hedge system, it is directly attached to my main algorithm trade. So there would not be a hedge. There is no hedge without a main algorithm trade. So the main algorithm, in the current scenario, at trade number 2, it places a hedge, an equal and opposite trade. Our problem is the challenge. Let's not even call it a problem. It's not a problem. The challenge is to be able to maintain that hedge during, a price drop and maintain it with all of these wicks look at that huge wick down there, attempting to take us out of that hedge before we get to come back up here and take profit. So here is the management issue that you have to be aware of. I'm going to see it. Just follow along with me here. Let's say the algorithm is in buy mode. Okay? And the price is dropping like it did here. That's pretty much how we trade. So we've entered a buy, a buy, a buy, a buy, a buy, okay? And as we've done that, let's say our take profit is right in this area here, okay? Our take profit has moved down to this area. Now, as we are hedging, we have an equal and opposite trade, a hedge on every one of these. So we were buying, we also have a sell, a sell, a sell. So what's going to happen is, as the price turns around and heads towards take profit, there's no protection on these hedge orders. So the only hedge order that doesn't necessarily require protection, or really there's two of them, are these two at the top here, okay? Because they're up near the take profit. From a management standpoint, if we get enough up top here above our take profit because we were in early and the hedge survived. We were in the hedge early and the hedge survived. We can literally afford to take losses on potentially these down here because the entire basket has profitability up here. Our problem in the past has been is that all of our hedges were down here because they were too late. The price bounces in and out of them. So now all these things are negative down here, and it's eating up all of our profits above here. So the chance that you have to take is that when the price moves down a little bit and comes back and takes profit, that is not going to be the most profitable or even a profitable trade. There are other scenarios where the price moves down, comes back up in a kind of a big movement here, and you've got some hedges that are down here that are negative. All you can do is manually get out of these. You're like, okay, because here's the deal. The system auto-placed all of this stuff. It is helping you. It is helping you immensely. For you to keep up with that and add a trade and add a hedge and all this stuff, you wouldn't be able to do it, especially across 22 currency pairs. But this system will do that. And remember, I'm going to go on to a big caveat here at the end of this rant. So what's the management technique now that you have these auto hedges going? You probably need to get out or get back in on your own, depending on what the price action is doing. It's a gut feeling. Me personally, I'm going to let it roll because what I want is I want to be able to bid more. I want to take more risk. Let's just call it bidding more. I want to take more risk. And I want to take my risk. Let me think if that's the word. No, I want to diversify because here's the deal. You get caught up in one particular pair and you get caught up in a pair that you don't like the way it's moving. And yesterday, people were in NZD JPY with the auto hedge and they took a slight loss because the auto hedge really was just getting killed on the way down. Just got taken out. And then all it was left was the stuff at the bottom. Had you not had the hedges at the top taken out, the few at the bottom that ended negative, these up here would have balanced out the trade. So hedge survival is key here. By the dynamic and the fact that you have to keep the hedges alive, you also have to take more risk. Because you can get some hedges down here at the turn, and they go negative, and when the entire basket of trades closes from the algorithm, all the hedges will close too, because they are literally exactly attached to the main algorithm trade. So we don't need a stop or a take profit on them. However, what you can do from a management standpoint is you can manage it on your own. Build your own intuition. That's something I can't teach. Intuition in the sense that, should I get out of this hedge down here? Maybe I've got a rule that says when I'm in a hedge down at the bottom of the turn, and we don't know it's the turn because it certainly could come right back down here, right? You just have to be ready for that. You might say, okay, I've got all of my hedges surviving, so I'm feeling pretty good. But in these couple down here, I'm going to go ahead and get out of them. You could do that. Should you do that? It's intuition. Should you at least practice? You should. It is purely intuition. And what I'm going to do is I'm going to apply, you're going to get me backing you up because I'm going to apply some of my intuition to what is happening here. If I catch it, if I see it, and I see a hedge down here that I didn't like, and I feel like the price is headed back towards the take profit, I'll just get out of it. I'll just take the loss. Because we are doing mathematical trading here in a basket of trades. Dollar cost averaging, we're averaging in, so on and so forth. So I hope that explains a little bit of it. But it's a little upsetting to me that people freak the fuck out when I tell them they have to manage their account. What do you mean? I thought this was fully automated. I mean, it is. Right? It is. But you have to pay attention to it also. I mean, you want to make the big money. You want to make income. You want money for nothing, chicks for free. What do you want? You don't. There's not a lot of work involved in this. In fact, that's one of the reasons I did it. There's no work involved in this, really. Just a little bit of brain power, a little bit of controlling your emotions. Probably a lot of controlling your emotions. All right, let me take a look. I see some of y'all talking in here. Demi says, "Can we go over Euro JPY, if you don't mind?" Why? Yeah, what's significant to you about Euro JPY? And where are you trading that from, and why are you trading that? Let's see. I'm looking at some other comments here. Let me put this on the screen here. Derek says, so the only way to stop the hedge from getting taken out is to not set a TP or stop loss and let it play out. That is 100% correct. In essence, a buy and sell trade will always be trading on that pair until they close. Yes, that is correct. That's the idea right now. It may be wrong. Maybe the answer is a trailing stop that slowly trails, okay, and then takes you out at a profit as it moves back in. There's still options, different ways to look at this. But right now I'm like, you know what? At a minimum, looking at this, I need the hedge to survive. I need the hedges at the top to survive. Otherwise, you're taking a bunch of hedges at the bottom on the turnaround and you're screwed. Mathematically, you're screwed. Because if you had 3 or 4 hedges at the top that survived, instead of 3 or 4 at the bottom, mathematically, it'd either be a lot less loss or it'd be a break even or a slight profit. So Mark says, what you're explaining is exactly how I envisioned auto hedge. Have to look at this monthly. Yeah, I mean, please don't look at it on a daily basis. But, we know my algorithm works extremely well. My algorithm never loses. So the part of the game that we have to play is we don't, these market makers they jacked us pretty hard last year, right? So think about it this way, because I'm talking about launching a new membership level called Portfolio Manager. And really what it is it's trading every individual pair on its own account. That is what it is. I would suggest a minimum of $1,000 per currency pair. And then a relatively conservative bid, 0.02, 0.03, 0.05, right? You probably could trade up to, like, high risk would be trading a 0.10 base lot size on a $1,000 account. And that's trading one pair with auto hedge. And what you get there is if one pair took a $25 loss that day, because of the price action of what's going on. 7 other pairs made a $25 profit because you're trading all 22 pairs. I envision having a portfolio of at least 25 accounts. So 22 pairs individually. So that's 22. The 23rd would be gold. The 24th would be the OPP feed with auto hedge. And 25th would be the 10 pip hybrid with auto hedge. That's what I'm thinking. Okay, just for diversity. I have enough algorithms where we could run, 30, 40, 50 $1,000 accounts with different algorithms on them. But the base portfolio manager is trading every one of the 22 currency pairs in my system with auto hedge. And what you get is you're going to get the diversification of volume across 22 pairs. Because, look at this. AUD, CAD. We've been in this, a couple days here? Day or so. There are 21 other currency pairs out there making money right now. Some are sitting there, some are not. Some go into a trade and immediately profit. So, I'm going to go to the pause here because Demi said something about Euro. Let me go back and look. Here's the pause screen. Euro JPY. Let me pull up the full algorithm and see if something is happening with Euro JPY. I'll share this with you. So looking at the full algorithm here, remember we were about a $2,000 drawdown yesterday. Am I right? Now we're at a $500 drawdown. So we'd have had enough movement, enough closure. We're in dozen and a half. And there's Euro JPY. So the closure, $358.08 of closure overnight. So that's pretty nice. A little bit of volume. And again, I said that was going to happen, right? Because if we looked at the Forex factory news, there's some high impact news starting today. Today, which is Tuesday, Wednesday, and Thursday, looks like when they've decided to move the market. But it's not always directly attached to or related to high impact news. They just use that as a reason. All right, so let me take a look at Euro JPY here. So we're in 1, 2, 3, 4, 5 trades. And this is just the regular algorithm. Let's go look at the chart. So we're on the 30-minute chart. We're in some sell trades at the top here. And the TP is down here. Wow, that's going to be a really nice trade because they have to fill these gaps. They got to fill these gaps. So yeah, it's looking good, feeling good. But you had said, Demi, you said, can we go through Euro JPY? So I kind of feel like you mean something more than that. Like, what do you mean? I'd be curious to know how you're trading that or what you're trading that on. So it must be on. I'm going to pause here. Is it on the 10 pip hybrid? Let me go look. Let's see. That would be this account here. Nope. 10 pip hybrid feed is AUD, CAD, and Euro Chief for the week. $42.82. Remember, this is the feed. So it's coming out at a minimum lot size. What you can and would do with your account is you would scale it, scale it up from there. So 10 pip hybrid doing well. I'm going to say this again, guys. We are in an extreme right now. I have not seen anything get jacked up. So remember that what's going to happen is, let's say we have a smooth market for the next 90 days. Here's what's going to happen with everybody. And I already see people doing it. Well, can I change feeds? I want to go from OPP to 10 pip. I've seen some guys say 10 pip. And then other people are like, well, I'm in the 10 pip. Can I move to the OPP feed? Because I heard someone else is crushing it. those people have intuition and they've been trading for a while, and they're trading their system. I won't even begin to tell you how many manipulations you could do with any of the feeds that I send out. You can manipulate them in all kinds of ways. And I'm not even going to tell you those ways because it's not as useful. You know, if you're ADHD and OCD and all this other stuff, then your brain will come up with ways to make this video game a little bit more exciting. But remember, auto hedge, if it's taking some losses along the way in this very slow, smooth market, that's why we're doing it. We're getting ready. We are fully ready for an AUD JPY July 11th, 2024 scenario. We are right now, if that happened, you would crush it. Because there's nothing killing our hedges on the way down or on the way up. So listen, if I trade something on auto hedge for a month during some decent price action, again, it's very slow right now. I think we're waiting for the inauguration to go off. You literally could take your account right now, not trade auto hedge, and probably bid a lot more than you would even imagine, and you do really, really well right now. And that's the game. So for the next 3 days, 3 weeks, or 3 months, or even 6 months, they are lulling you into getting comfortable. They're like, this is a great market, man. I'm just going to keep jacking my bids up. I'm going to keep compounding my account. So you go from a $3,000 account to a $6,000 to a $9,000 to a $12,000. And then one day, July 11th, 2024, AUDJPY wrecks your entire account. So, what if you started thinking the portfolio manager level? What if you had AUDJPY running on a $1,000 account with auto hedge and it ran away from you, but all the hedges were maintained? You wouldn't give a shit. You would not care. Because potentially you've got $21,000, maybe you've got 5 other. You've got 5 other accounts, $5,000 in play in the market. So maybe you have 6,000 total, let's say. And that one goes a little haywire, you don't care. It won't affect you emotionally as much as it will having a $30,000 account with AUDJPY on it on July 11th, 2024, and you've been fat, dumb, and happy for months and months. Keep cranking up your bid, because that's the entire idea. That's what the market makers do. Let's just leave everybody smooth, and then we're going to take all of their money at once. Because they don't give a shit about taking $25 from you today. What they give a shit about is taking $2,500 from you as you've compounded it over the last 90 days. Or $22,500 after you've compounded it over the last... Like, they're like, go ahead and accumulate, because they know what you do. They know how you trade. Greedy. You're greedy. So if you can be a little more strategic, a little less greedy, if you can head towards the portfolio concept, 22 accounts, let's say, $1,000 each, you've diversified your risk. When 1 or 2 of those pairs over the year goes apeshit, you're ready for it. You got auto hedge playing out. Some $1,000 accounts will break even for the month. Some will have a slight loss. Others will have a profit. During crazy market times, those others will have incredible profits. So at that point, you won't start looking at it hour by hour, day by day, week by week, month by month. You'll be looking at it 6 months, a year at a time. Wow, look at this. Because if you look at AUDJPY And had you been able to make that trade profitable in July of 2024, that would have added probably 50%, I think 55% to your bottom line, just that trade alone. Or you could have lost it all during that time also, had you not had protections in place, so on and so forth. Had you been over trading on a large account, over leveraging, overbidding, and then you lose it all. So it begs the concept of, should you withdraw your profits on a weekly basis? Bi-weekly basis, certainly monthly basis? I think you should. Because this is a game. Because you're going to blow an account here and there. So maybe quit blowing your compounding. Pull your profits out. Trade the $1,000. Trade the account. Whatever balance it is, pull your profits out. That's the idea. I don't believe there's any other account I really want to look at. The market did this push. Let me look at the accounts real quick. The market did this push last night where we were like, $2,000 drawdown overall system. And again, that's just a main reference. That's not what you would have because you're bidding something different on your account. But we had about a $2,000 drawdown yesterday, $500 today. Had about a $100 closure yesterday, profit-wise today, nearly $400. So the market is giving us what the market is giving us. Let me look at one thing, see if this is worth sharing. Yeah, this is kind of interesting. I'm going to show this to you. So this is an extreme scenario. This is a test account where I'm trading the one profitable pair feed. So we've got 3 sell trades, and then it did a buy. We've got a hedge down here. Now notice this hedge, it looks like this entire thing is heading towards profit. So let me just show you something here. So we're in sell trades. Here's the take profit. And we got a hedge up here. So I'm going to make, right in front of you, I'm going to make a command decision to go ahead and get out of that hedge. Okay. It's this buy trade up here that wicked, and now we've moved away. So I'm going to take a loss on this hedge right now, just to show you a management style. I'm going to hit that. I'm going to hit close, and I'm going to close this. Okay, so I took a loss on that, and I'm going to let this play out, because here's the thing. Had I held on to it, the loss would be a lot more down here. We wouldn't get out of that hedge until we were down here. That hedge never had an opportunity to go into profit. That's the risk you have to take. That's the risk you had to take. And in fact, it wouldn't have mattered because I got rid of the break even and I got rid of the stop loss. So that is just the reality of this. Now, because I'm pushing this account and I've made over $6,000 in about a month here, I want you to understand that if you look at this, I've actually forced some losses, but I'm not done. I'm not done with this trade. In fact, the USD CHF trade here, because I didn't close out of that last hedge early enough, it ended up in a little bit of negative, and then I just took this negative here. But I'm not too worried about that. If nothing else, I can make up for this minus 377, probably with this trade. Okay? Probably with this trade. But that's the game you have to play, because look at what I'm bidding. I'm bidding a dollar per pip per thousand off of a base $10,000 account, but nonetheless 1.0 lot size, $10 per pip. You've got to take the profits with the losses. You've got to let the mathematics even out. My system is not going to lose from its main trade. But what I'm doing here is a severe manipulation in the sense that I'm way overbidding, taking a lot more risk, And I'm willing to play that game. I'm willing to play the game. And that's what game I'm playing right now with this test account. What's interesting is up to this point, started at a $10,000 account. Up to this point, I've made just a little over $6,000. There's been some crazy wild trades where some of the hedges, 2 or 3 of the hedges at once, were all $1,000 negative, and it closed out. And I'm still in profit, way in profit. Hedging and auto hedging is simply an additional AI layer on top of what we're doing that can potentially protect you when you get a July 11th, 2024 AUD JPY. That's, and oddly enough, look what I'm trading here. AUD JPY. Okay, I'm getting some alarm thing that is just blowing up my phone. I think that's it. Let me check one thing. Check one thing here before we go. Yeah, interesting. It's not working. So that's really what I wanted. That's really what I wanted to share with you. Yeah, I just wanted to make sure I got that entire stream of thought out. It's basically, I said I was going to go live yesterday and talk about, the hedge and the trades, the hedge that we were in yesterday that ended in slight negative. It's just the reality of this. I mean, if you don't want that, you gotta go trade a feed, and I'll give you a feed, or we'll work with you, or whatever you need, that doesn't have auto hedge on it. I want auto hedge. I want it. I want that protection on those crazy Tuesday afternoons when something goes crazy, and I had, there's no way to catch it. If you let the algorithm do its thing, it will catch every trade, every hedge, and maintain a level of profitability over time that you wouldn't be able to do on your own. So I don't see anything else. Demi says manually. So what that means is you were taking that trade manually. All I can do is speak to you specifically. Like, you guys are just all over trading. I see people taking 2 feeds that could potentially be taking the exact same trades because they're pulling from the same main algorithm. And then I see people manually, like, I guess that's okay. You're certainly going to learn a lot, but it's kind of like learning by getting beat in the head with a ball bat. Like, let the algorithm do what it's doing. Play the piano. It's like you're trying to play a different song on the piano while the piano is automatically playing. That's confusing. Right? Let the algorithm work and manipulate the algorithm. Manipulate the algorithm. Think about, I'm not even going to tell you how to do that because I'll make you dangerous, but think about how to manipulate the algorithm. Like, for example, if I was copying this particular trade we see on the chart here through Social Trader Tools, and I wanted another pair that I saw from the main algorithm, could I turn that pair on in this account, just that pair from the main algorithm? Of course I could. So that's a manipulation you could do. Are you over trading and excessively trading? You probably are. I know you don't care. You probably love that stuff, right? Demi says, I always try my luck. I'm not going to anymore. You're a gambler, right? You're a gambler. It's fine. It's fine. If you're going to have a live account with the algorithm attached to it and you want to take manual trades, go set up a demo. Get good at it first. Don't experiment with your live money. Like, sometimes we have to. Right now, we're kind of experimenting in the sense that we've got auto hedge attached with the one profitable pair feed, and it's a little bit of an experiment. I mean, the concept works, but you can also end a trade in a slight negative. We know at least the main algorithm is always going to win. So what's the auto hedge for? It's for when the market makers decide to really jack the market up and go farther than our accounts can handle. So, all right, I'll stop there. appreciate you guys watching. fxwithterry.com. Come join the free Discord group. Bunch of changes coming up in the next week or two here. I'm doing a bunch of work behind the scenes, moving my website to a new hosting server, so on and so forth. So hang in there. But if you have any questions, then hit me in the group. I will see you tomorrow, Wednesday, January 15th at 9:30 a.m. Mountain Standard Time. I'll see you then. Take care.
Thank you for joining us on the Forex Trading Daily Live Show. Get access to all of the free trades with full auto trading at fxwithterry.com. Be sure to subscribe and get notified of the daily live stream. And get ready for your next profitable Forex trade.